The latest jobs report roils stocks and sends Wall Street's fear gauge soaring. I'm Lisa Bernhard with Reuters, and joining me today is Eric Lynch of Scharf Investments. Eric, okay, data from the Labor Department today, the jobs report show that the economy added 114,000 jobs last month. The estimate was 175,000, and the unemployment rate ticked up to 4.3% from 4.1%. But a lot of those jobs, economists are saying, or part of that unemployment rate, I should say, are new people coming in to the workforce, perhaps immigration induced, that are looking for jobs. So stocks are down big time today. Is the market overreacting? Are these numbers as bad as they appear on the surface? Not so much. Put it together for us.
There's maybe not an overreaction. There's basically kind of a rotation or broadening happening. And basically tech is getting impacted because the valuations were really expensive and Q2 results are a little bit less than anticipated. And then meanwhile, coupled with the jobs report you cited, which wasn't that bad, Claudia Sahm herself, the former Fed economist, said today, look, it doesn't mean we're in a recession just because our kind of 3-month moving average unemployment rates ticked up more than 0.5%. It just means that things were definitely going in the wrong direction. And I would agree with her. Coupled with ISM report missing yesterday, manufacturing kind of future orders were significantly down. Jobless claims also jumped yesterday. All those things coupled together, Lisa, mean that the economy is slowing down. There should be some concern with stretched valuation stocks. AI trade, there's no return really yet per se from the $200 billion of CapEx investment into it. And so rightly so, investors have done an about face, scrutinizing tech and looking for new areas. The good news, there's plenty of things that haven't moved, Lisa, in 18 months, and the valuations are good, and they've got earnings that aren't really impacted by a slowdown in the economy. And we see a lot of opportunities there.
All right, I want to circle back to that point in a minute, but you referenced Claudia Sahm, she of the Sahm rule. So there are headlines today that was triggered by the jobs report. Just explain why that is, but you're saying you're not concerned. Explain that.
Yeah, the Sahm rule is just, look, every time there's been a 0.5% increase in the unemployment rate, which is kind of surprising because it doesn't sound like that much. There's actually it's been associated with every prior recession. So that's concerning. The reason why we're not mega concerned is because there's been all sorts of distortion in jobs data the last few years. First, you had the pandemic. Now you've had massive immigration. And so it's something that I think is an important data point, and we look at it, but I think it needs to be coupled really with what else is happening in the economy because of those two factors I cited, as well as what we're seeing in company reports. What we're seeing in company reports as a money manager is a significant pushback from the consumer on pricing, whether it was Starbucks, McDonald's, Amazon last night. You're seeing Amazon down 10% because they cited consumer pushback. Year-over-year retail growth for retail sales on the Amazon platform was only 5%. That is not, really that fast considering Amazon's prior growth rates.
Okay, but at the open, I did reference Wall Street's fear gauge, which is the VIX, which is very high today, right? So is that concerning? Explain that to people who don't know what that is and what that means.
Yeah, the VIX is a measure of implied volatility for equity markets. And the higher it is, there's more kind of fear in equities. So it's been bouncing along a historical bottom for a few years, and this year to date. And just in the last few weeks, it's doubled. Today, Lisa, it's up 36% last time I checked. So what it means is that investors were really complacent coming into Q2 earnings season and the Fed's Wednesday report. And so now they're getting scared. Why are they getting scared? They're getting scared because it looks like, oops, we were worried about inflation. Now, careful what you wish for. We're really worried about a slowing economy all of a sudden. And so that being the case, you're seeing a flight to defensives. So one of the things I like to cite in yesterday's market action, Lisa, is that even though the S&P 500 was down 1.4% roughly, there were 4 sectors that were up over 1%, and they were all defensive: utilities, real estate, healthcare, consumer staples. So This is interesting because those things have lagged so poorly, flat to down last year, this year, kind of anemic, that even though you're getting a market retrenching out of this fear, it's being hijacked or being led by the kind of tech wreck we're seeing, at least for now. And so there's areas to make money. So it's not all doom and gloom. It just is probably a healthy recalibration for an equity market that has been hijacked by tech. Tech is great, great secular growth, but investors got over their skis on expectations and valuations.
All right, so let's now talk about the Federal Reserve, right? Rates were unchanged this week, and it's funny, on Wednesday, investors were rejoicing and saying, oh, soft landing looks like it's in sight, right? And now we're talking about the possibility of a recession. But so markets were expecting a 25 basis point interest rate cut in September. What are investors expecting now for September and beyond?
Yeah, well, clearly, if these data prints we've seen this week continue along these types of trends indicating slowing economy, yeah, you're already starting to see a 50 basis point becoming more of the consensus for September. That would not be shocking if this continues, for sure. Guidance is okay, but not great. I think it's important to understand that a few data prints don't make a trend. Definitely things are slowing. There is still a potential for a soft landing. It is more murky than it was a few days ago. But again, because you had this very bifurcated equity market kind of dynamic for a while now between tech and everything else, that everything else stuff looks attractive. And it could grow. We have a company in our portfolio that reported last Friday. It's Centene underwrites medical insurance for kind of lower income US consumers. They have leading market share. They beat on estimates. Stock is up almost 20% in a week. It was 9 times earnings heading into the release. It's now 10 times. So this is not expensive versus the Max 7. It's still priced at 30 times earnings for 2025 estimates.